Hey folks, welcome to Pro Trader Strategy, Spotting the Trade. It's Friday, September the 3rd. On the floor, we used to call it Unenjoyment Friday because we get the first read on the real unemployment numbers here in the United States. But before we get on with that, let's talk about what we're going to do here today. I'm going to talk about the economic data, see how that really impacts the overall markets. And then ultimately what we're going to do is find some option strategies that we can implement around our given assumption from all our technical analysis and everything else. So if you want to learn a little bit about that, right down there at the bottom, there's a subscribe button. Click on that, and right next to it, there's a bell notification. That'll give you a heads up when I come on unannounced. I almost did that this morning when I put on my trade, and then I thought, you know what? We got it scheduled at 8:30. I'll just wait for that. Plus, we had Biden speaking and everything else. I didn't want to try and overlap that. So I might come on unannounced or a little bit earlier for these spotting the trades. When I spot that trade, I'm going to come on. And throughout this video, make sure you guys are commenting over there because I want to make sure you're clear concept. If you guys want me to look at a specific stock, ETF, future, something I might not be covering right now, hey, throw it over there in the comment section. I'm keeping my eye over there. Make sure you guys are participating, all right? And finally, smash that like button. I like to think of it as when you hit that like button, you're throwing those bots in the interweb a little cookie. And what they do is they run out there and find somebody just like you. So that helps out. So please smash that like button, throw that robot or that little crawler a cookie, all right? So let's talk about the economic data across the pond. Overnight, we got Australian retail sales. Now, we've been seeing these retail sales numbers come in pretty bad. I mean, I even talked about Canada. We don't usually talk about Canada, but their retail sales earlier on in the week came in pretty lackluster at best. But Australia, negative 2.7%. It was expected to be close to negative 2%, but still missing on that number. Not so great. Then in Europe, we got our final readings on the flash estimates. Remember, we were talking about the services PMI numbers, just purchasing managers index. One of my favorite numbers. Why? Because it's forward looking. These purchasing managers see the demand coming in and they either increase their buying or pull back on their buying of the raw materials that go into the manufacturing process. That's why that's important. This is the service sector. Spanish, Italian, German, Great Britain, pretty much in line with those original readings, so I'm not really going to dwell on those. But one thing we did get was the European retail sales as well, negative 2.3%, expected to be unchanged. They did revise last month's number up, albeit just slightly, not enough to make up for that headline number. Then we're over here in the United States. We got our average hourly earnings. That increased. Well, we got a little bit of a heads up on that with the earnings numbers earlier on in the month. But that number came in at average hourly earnings came in at 0.6%. As a matter of fact, the reason why I want to talk about that, that's one of the highest levels we've seen in a while. Right here, right after post-pandemic, it's been a little bit jukey. So a 0.6, I mean, last month we did get a pretty decent number, but we were expecting 1.5%, or sorry, 0.3%, getting confused here, 0.3%. 0.6% historically, what I want to really say is historically, the LEI before the pandemic, a 0.6% is a really high number. Now, we've had a couple of numbers that were higher recently, but a 0.6% no is a pretty good reading there. So average hourly earnings increasing while we're seeing an actual slowdown across the economy. Non-farm payrolls, the unemployment number I was saying we were looking for, came in at 235,000 hires. Well, it was expected to be 720,000 hires. So a big miss on that headline number by about 500,000. Now, we heard Biden talking earlier today, and he was blaming it on the Delta variant, when in fact, it really probably was the fact that the government was supposed to hire, expected to hire 200,000 workers, and they laid off that 200,000 workers. So that number flipped by 400,000. That's a big miss from just that sector. Now, don't get me wrong, travel and leisure was lagging there, but one of the biggest drivers of that miss was the government or lack of government hiring there. The unemployment rate did remain unchanged at 5.2%. Here in the United States, we also got our Institute for Supply Management PMI number. That's the one we really look for. Yes, we did get our flash estimate along with everybody else. and our final numbers came in line with expectations. But I'm waiting for the Institute for Supply Management number, PMI, that came out at 61.7, expected to be 61.9. So a good number there for us on the service sector PMI number. Something to note also, we did the video yesterday on the strangle. I did that. I posted that out there yesterday. Make sure you check that out because I implemented that trade today. We'll talk about that here in a moment. But before we get on with it, let's talk about the markets here. We've got crude oil coming off a little bit. That's not going to be too surprising here, folks. If we see manufacturing slowing down here, we're going to see the demand for the distillates wane a little bit. Something else I wanted to talk about with this whole issue with the economy going on right now, we're seeing a little bit of inflation creeping up, all right? During that time, we're also seeing inflation as it's increasing. Our manufacturing, everything is slowing down. The economy is slowing. So we're kind of getting ourselves into a situation here where it's a bit of stagflation, where we're seeing these prices jack up due to the supply chain issue. And that supply chain issue is exacerbated by the fact that folks, when they saw this, there's when you're manufacturing, there's just-in-time manufacturing. What that means is you hold inventory of the raw materials that you're getting ready to turn into some widget, right? Well, those inventory levels, you hold at a certain level, and when the shipments come in, you're supposed to kind of be out of your inventories when the new inventory of raw goods comes in, all right? So that's just in time. Well, during the supply chain issue, right, we saw, especially the chips for, like, say, the Ford F-150s get backlogged. Now those folks that are in the manufacturing sector are not going along with the just-in-time anymore because they've got this in their head now that, hey, we don't know. This could happen again, right? So they're not just trying to make up for the backlog. They are trying to make up for any backlog that might come in the foreseeable future. So that is causing the manufacturing sector in China to really increase, right? Well, is it really due to the demand of the consumer or the demand of the manufacturer? That's what's got to be kind of sorted out here. But all of that, those folks adding in the extra inventory is also exacerbating this whole supply chain issue. So that is also something that's hurting. Travel and leisure, like I said, is going down, but we're seeing wages go up and slowing growth. That is not a good combination. That's harder to get around than recessions, okay? We can play around with recessions relatively easy. So we would rather see a recession than a depression, which is even harder to get out. And the worst to get out of is stagflation, okay? That is something we do not want to see lingering around for very long, okay? Very difficult to do any type of monetary policy around that because it can really make it worse. All right, so with the markets, I'm going to kind of rip through these so we can get to some of my trades here. We've got crude oil is coming off, bonds coming off surprisingly because this economic data point that we've been talking about recently is a sure sign that the Fed is not going to taper, probably not before the end of the year in my eyes. A lot of people are trying to just roll that back to maybe November or December, but I think it's actually going to roll into the 2022, which I've been talking about for a very long time. So bonds coming off a little bit means interest rates are creeping. I don't think that the Fed is going to slow that asset purchase, so I don't expect this to stay bearish for very long. And then we look at Bitcoin, it's moving higher. A lot of these altcoins, Bitcoin, cryptocurrencies, gold should see some strength here if we're seeing stagflation, folks. That is going to be the flight to safety. And we're seeing Bitcoin move higher. I don't know where it happened to my gold chart. Gold is moving higher as well. And it should even go up and possibly test our value area here where we spend a lot of time up at that 1900 level. I think we're going to definitely look to test that 1900 handle in the coming, probably in the next month or so, or within the next month, I would think, if we're going to continue to see inflation creeping higher and the economy slowing or even moving down. NASDAQ is moving to the upside. Why? Well, because a a lot of people are saying, hey, we're not going to get away from all of this tech, especially like DocuSign. It's kind of become a nomenclature where people are saying, hey, we like this thing. We're getting away from paper. So that's going to stick around. I think a lot of people are accepting a lot of tech in their lives, and that will go forward despite the fact that we open up. So tech moving higher here in the NASDAQ, while the Dow Jones Industrial Average, any type of reopen trade, is suffering a little bit today, especially like the travel and leisure, as we saw with their data points. They were not hiring as well, which leads us to believe that they're not doing so good, right? Dow Jones Industrial Average off by about 87 points there. We can see the E-mini S&Ps pretty unchanged right now. We're flattening out. This is kind of that whole rubber band effect where are we going to snap up or snap down? Anytime we start getting this consolidation and tighter range, that indicates that we're getting ready for a big move to happen. Something I wanted to talk about with this one, I didn't take the opportunity to go down and break this down, so I wanted to show you guys how to set this up on the platform, and I, for some reason, am drawing a blank on what I need to do here because I'm trying to think of what I want to do for the next trade. I want to break this down on the, I know what I need to do here. I got to go to the, choking here. Said 15 minute. That's not what I want to do though. I want to go over here and figure out how to set up my chart on, this is what I want. I want the volume profile, sorry. Click on this, automatic. I want to click it down to tick size, chart. I want to go to day, and then on expansion, no. Okay, so what that's going to do is that's going to send the blue, which is where we're seeing the volumes trade, on a daily chart. So when we hit that, we can see now I've got the breakdown on each day. And the reason why I like to do this is because it gives us a pretty good indication as to when we get this winding up effect. We have several inside days lined up. That usually is like that balsa wood idea where you twist the propeller and that rubber band just keeps tightening up. And then when you let go of it, the more you tighten it up, the faster it spins, right? So the longer we stay in this tight little range inside days where basically all of these little red lines line up inside the previous day. We've got a couple of them a little bit slightly outside, but for the most part, we are in line with one another. And that is one of those indicators that we get to say, hey, there's a big move imminent. So if you want to set your charts up like that, or if you like trading around the market profile, check out a couple of those videos where I specifically talk about how to trade in and around something like the market profile. So make sure you comment over there at the side if you guys have any questions, comments, or anything else throughout this video. Hey, and if something like this helped you out, smash that like button, feed a bot to go out and find somebody else that likes volume profiles as well. All right. It's the psyche of the market, really. All right. Wind is coming off, not surprising. Travel and leisure not hiring. They were saying there was a little bit of suffering going on there. I am trying to get out of a few of my trades there in that travel and leisure. You guys know I've been playing this to the upside because we were seeing Caesars showed that they really streamlined their process, increased their margins, even throughout the pandemic. I thought the rest of the folks were going to be able to do that, but just the headline number of this possible slowing down of the economy. I mean, Biden even said that the miss was due to the Delta variant, which wasn't probably making the consumer any more confident. But we got wind coming off a little bit. I have on some short puts in there that I've been riding for a little while against the calls. Remember, I got long some September 135 calls. Well, those folks are not probably going to work out, but I'm going to leave them on. It's not worth taking it off for a nickel or something. And something beautiful happens in this market, shoots off to the upside. I don't expect that, but who knows? Anyway, I had sold the September 95 puts against that. I'd be more than willing to buy it down there. Having said that, Theta has eroded. It's trading around 90 cents. I'm trying to get out for 50 cents. So a little bit off the market right now, but just wanted to give you guys a heads up. This sector starting to look over. Any bullishness in there, I'm trying to thin out a little bit. So trying to take off that win trade here as of right now. And Pfizer is also another one. I don't know why it didn't pop up on my flip through these. Let's talk about Pfizer first, and then I'll jump into my XLU trade that I put on today. Pfizer, I'm also trying to get out of my September 44 puts in there that I originally sold for about 40 cents. I'm trying to get out for a nickel. It's trading around 13 cents. Again, just a heads up, I'm trying to get out of those, got working orders in the markets. I don't know if I'll pop in later on the day to tell you guys, hey, I got this for a nickel. All right. So XLU, though, I did add as a strangle in. Actually, I did this as a straddle. I did the strangle webinar yesterday. We talked about those strike locations, but today going into this, I think that this is going to stay in a relatively tight range. So I decided to do it with the straddle instead. I'll do the webinar on the straddle next week, but to give you guys a brief overview, we're doing around the 50 delta call and put, selling those both. That's what creates the straddle and the strangle. But the difference is the straddle is the same strike. The at the money is okay. So I did the October 69 straddle. All right. So both selling calls and puts. I got a total collection of $2.80. So my break even, you add that credit to the call side. My break even to the upside now is almost 72. We're going to call it 71.80. That puts me above this Fibonacci there. So my break even being above that, and to the downside, we subtract that out of the 69 to the downside. So basically my break even on the downside is 65.20. So 65.20 to the downside. That puts me right on this support line. That's why I picked the straddle over the strangle. Strangle, I was still able to get those strike locations like we talked about yesterday. My puts, though, were just a slightly little bit higher there. So I decided to go with the straddle in order to be able to get outside of those two Fibonacci's. Now, this Fibonacci is from the high of pre-pandemic. Okay, so we're very close to being retraced to that. Now, if we have a slowing economy, I think these utilities are going to slow down as well. All right, which would cause us to move sideways. And I talked about all the reasons. You know, anytime XLU has a tendency to get one of these big moves to the upside, folks, we see a consolidation period. Again, big move, consolidation period, big move to the downside, consolidation period, big move to the downside, consolidation period. So with this big move to the upside, I'm expecting a bit of consolidation in and around this level of 60, upper 60s, 65 to 69-ish area. I don't really expect us to blast off above 70. More risk in this is to the downside in my eyes. All right, so that's all I've got for you guys. If you've taken anything away from that, make sure you guys hit that like button, because that sends a bot out there to find somebody just like you that they think will benefit from it. And I think that that will work out quite nicely. So make sure you feed those bots by smashing that like button. Also, hit the subscribe and that link right next to it. There's a bell that gives you a notification if I come on unannounced. All right. And I'm going to be doing that probably more often when I find trades. Yes, we do schedule it for about 8:30, but I'm talking about we're going to make that 8:30-ish. Okay. And comment over at the side. I'll circle back around, folks, to make sure you all are clear of concept. All right. That's all I got for you. Have a great weekend. If I find anything later on this afternoon on a trade, I'll let you guys know. So if you can't take that, take it easy.